Ladies and gentlemen, I am Vanessa and I'll be your host for this session. Good evening and welcome to the WebEx session on COVID-19, Rethinking Fund Terms and LPGP Dynamics. This session will be presented by my colleagues Richie Sancheti, Nandini Pathak and Ishan. Please note that this will be in listen-only mode and will last for about 60 minutes, out of which the first 30 to 40 minutes will be spent on panel discussion. The remaining time will be available for Q&A. Requesting all participants to be on mute mode for this session. You can post your questions in the chat window while the panel discussion is on. The moderator will queue up the questions for the speakers accordingly. Should you need any assistance during this conference call, you can use the chat option. Do note that this conference is being recorded. I now welcome our session presenters, Richie Sancheti, Head Investment Fund Practice, Nandini Pathak, Leader Investment Fund Practice, Ishan Vyas, Senior Member Investment Fund Practice. Over to you, Richie.
Have joined us for a session on the dynamics in LPGP negotiations and the fallout of COVID to all these conversations. We have with us on the panel, along with me, my colleagues Nandini Pathak, who's a senior member and leader of our fund formation practice group, and Ishan Vyas, another senior member of our funds practice group with me. So with that, I think I would start with a brief overview of what's been happening in respect of the current environment and what are the developments over the last month or so when the true flavor of COVID has sort of dawned upon across the various constituents like the LP, GP, and so on and so forth. I think to begin with, the first point we have observed is that more than the COVID itself, it is the reaction of different governments, regulators, etc., to how to deal with COVID is where the bulk of the sort of implications are coming from. So to begin with, while governments have sort of paused any foreign travel, both inbound as well as outbound across all the major jurisdictions, I think a key pressure from an India perspective is the restriction on Europe. As a lot of the participants who are tracking Indian fund industry would be aware of, there are significant portion of the capital being raised in current times by a lot of tier 1, tier 2 GPs is from the DFI participation. There we have seen a significant raise coming from DFIs who are evenly spread out across the different EU participant nations. And accordingly, a travel restriction does restrict the interaction that can only happen through physical sort of interactions. And accordingly, the action has definitely shifted over conference calls and WebEx sort of sessions, but it does definitely hamper the interaction. More than those, I think what we've also seen as a reaction is that recently Eaton Partners had carried out a 2020 March sort of survey on what is the mood of the LPs and what do they sort of foresee for the coming short to medium to long term perspective on what's the fallout of this entire situation. So the first reaction was that about 30% of the LPs are looking to sort of take another call on which geographies are they allocating to and what are the strategies they're allocating to. Mind you, this audience was not just the DFIs, but a global spread out LP base. Because DFIs obviously are more tied to the jurisdictions which sort of check the box for them. And despite the situations, they are sort of focused on those jurisdictions. Having said that, we have had discussions with a couple of GPs who have sort of taken up DFI commitments. And even though one would like to think that they are in a more cushier position, because DFIs ideally should represent a lot more stable form of patient capital, and because the source of the capital is not literally retail or family office, but it is more institutional in nature and supported by various governmental agendas, uh, one would have thought that that sort of capital should be immune to what's happening currently on ground. Unfortunately, that is not the case. A lot of the teams which are behind the DFIs have now a slightly different aspects in their strategy and what they're focusing on. And accordingly, we have seen some of the GPs who have recently concluded their fundraise have been asked to sort of slow down by their DFI LPs. That look here, you have already a situation with your current portfolio. Even though you may have drawn down, let's say 25-30%, you are sitting on a dry powder. We do appreciate that it is a great time to sort of negotiate and revisit what were the terms of investments, but we still would want you to sort of pause the investments because we ourselves have different priorities that we're looking at. Now, obviously, no GP, even though they're sitting on dry powder, would like to draw down from LPs, especially after this sort of conversation has happened, because calling an institutional LP as a defaulter or sort of drawing down when you know that there is a real situation happening at the LP end would literally be, it could not just spoil the relationship in a current fund perspective, but it may be a more permanent damage to the entire interaction. So with that, I think let's now also look at how the different governments have been sort of interacting and what are the positions that are coming out. So to begin with, Indian regulator SEBI has while clarified that all the infrastructure providers, like whether it is the capital and debt market exchanges, brokers, custodians, depositories, the funds, AIFs, etc., will continue to operate uh, even though on reduced sort of work stream and work capabilities. Uh, they have definitely banned short sales, or to be honest with you, that is the flavor from a lot of jurisdictions. And now this is a comment for those funds which are focused on public markets, that investments or strategies which focus on any investments, whether it is a short sale or any instrument which can confer an advantage or a financial advantage in the event of a decrease in the price of some covered stocks, is being banned. So nobody wants the cash equities to suffer in their home markets, and accordingly, there is a, a lot of monitoring, a lot of restriction on anything which can be seen as derivative of stock prices going down. A flavor of that has already come out in India, where SEBI has sort of enhanced the position limits and so on and so forth, rather the restrictions on those limits. The second aspect we have seen for the LP base at least is that of the denominator effect also sort of kicking in. Now, as an LP, a lot of the institutional investors or the larger family offices have some ratio of allocation between public equities and illiquid strategies like VC private equity funds. And suddenly they have seen a massive write down in value of their public equity exposures. In that case, let's say for the example, if let's say $50 was on public equities and another 50 in private equity or illiquid space, if the public markets have now come down by 40% and accordingly they are at $30, suddenly the ratio of instead of being 50s to 50 has now become 50s to 30, and accordingly they may also find it challenging to allocate any fresh unfunded commitments to illiquid strategies when they're already so high in their participation from a ratio perspective. Uh, so I think with that we will now get into the more granular nuts and bolts of a what are the recent dynamics in the fund terms which we are getting to see, but at the same time we will also get a sense, or we'll try to get a sense of what would be the new normal for the GPs who are either on their path to raise, have recently raised, or they are in the deployment of capital phase. They're sitting on dry powder and they're looking to draw down into investments. And those GPs who are more towards an exit mode, where let's say they are a vintage 2012 13 sort of a fund, and they are only looking to get meaningful exit opportunities. So what are the options that they have at their hands? I think some of the points um, around these will be covered, but a lot of emphasis will also be given during the session on the entire range of issues that we are seeing our GP clients take up, and what are the LP asks today in the current environment. I think with that, I will now turn to my colleague Nandini. Obviously, COVID, there is no escaping COVID-19 right now in any conversation today. But Nandini, in your experience and in your recent interactions, uh, how do you think this changes the LP outlook for those GPs who are still at fundraising mode? Maybe, let's say, they started some conversations to begin with, and now it has all come to a complete halt on the physical interaction side, at least. But they are still out there trying to make progress through their data rooms and so on and so forth. So how do you see this entire fundraising related dynamic changing now in the current environment?
Sure, Richie. First, thank you to all the attendees for expressing an interest in knowledge sharing even during these difficult times. So, Richie, to your question, yes, the current situation is likely to change the LP outlook for GPs who are at raising stages currently. But to my mind, in different proportions, depending on the operating history of the GP as a GP overall, and also as a GP to those specific LPs. Also, the change in outlook may differ depending on the LP that we are talking about. So let me try and touch upon each of these scenarios here. For first time GPs, this pandemic and its aftermath is likely to delay fundraising. And this is a common view among practitioners and placement agents and other intermediaries worldwide from what I have been reading. Operational due diligence is a key checkpoint for especially institutional investors and especially for first time GPs. So if this combination is coming together, then this pandemic is going to result in some delays. Operational due diligence cannot unfortunately be replaced with data room information and things like those, because you do need in-person interaction in the offices of the GP, as we most commonly see, and interaction between key investment teams and key point person contacts at the investor level. So that I think is a strong factor in dealing things. For GPs with a track record, known LPs may still be easier to tap. But for a newer set of LPs, the domestic set of investors may be closer to being integrated in the mix as compared to foreign investors. This is also because these foreign investors have global exposure. They are not taking their current stock of investments needs to be looked at again from a different perspective given the pandemic. They may want to take stock of their existing exposure, look at and examine how different regulators and different governments are dealing with coming up with fiscal and policy measures to tackle domestic situations, and then think about newer allocations or future allocations at this stage. But these are macro level touch points on these different scenarios, but there could be exceptions. For example, some foreign LPs may be more keenly interested in India focused funds for social impact, or for funds focusing on strategies post COVID, whether stressed assets or financing the MSME sector. And these are some conversations that we have been having over the past few days. Fund managers are coming up with newer strategies which are specific to post-COVID portfolio. So that could be a promising dialogue if you're tapping LPs globally.
Interesting. Interesting. Okay. So moving to you, Ishan, I think while Nandini did talk about what is the outlook on the LPGP conversation today, especially around the raise mode, uh, in your experience, what are some of the key terms that you've come across that are being discussed, and those which require a lot of calibration to sort of look at whether it is an overkill or whether it is a fair ask. So maybe if you could share some insight as to what terms, fund terms, are being negotiated right now.
Sure. Thank you. Firstly, the lot of the equalization and equalization premium related terms for subsequent closing investors or newer investors are often hotly negotiated more and more so in recent times. And now, considering the COVID situation, and especially even otherwise, we were seeing a shifting trend where the uh, the where more institutional LPs were sort of keen on having very strict equalization related measures in terms of how the amounts are repatriated to them, what kinds of other recourses, what kinds of ways those amounts could be utilized or channelized by the GP otherwise in the fund's operations and so on. And this may be subject to a little more sensitivity now, because for newer LPs who are entering at a time when the portfolios are much more are fairly depleted in value considering the economic slowdown globally, and this is especially relevant also for funds which are uh, investing more in liquid securities, given that the brunt of the economic slowdown is felt a bit more on the listed market side, and accordingly, we may be looking at a situation. GPs are looking for new capital at say more favorable terms, since they need to infuse more money in order to salvage the portfolio, and then how the older LPs would look at that or react to that, especially in light of recent circumstances, would be another interesting area to watch out for. And besides that, investor give back and additional return or carry clawback related terms have also been highly negotiated in recent times. For investor give back, institutional LPs from most of the Western hemisphere, or sovereign wealth funds, even from or quasi sovereign wealth funds on the Asian front, are also keen on having limitation periods which are restricted to 1 or 2 years. So basically, any claims which arise out of the or out of the operation of the portfolio of the fund, which arise after, let's say, after 2 years, uh, subsequent to the termination of the fund, then the GPs may not have recourse to try and recover that money from LPs. And this is more pertinent in India, since as compared to the global standards, India requires at least on the taxation front, you would typically want 5 to 7 years as a look back period for your investor give back related terms, and that often becomes a difficult ask from some of the LPs. And now, one
Sure.
of the yeah,
Sure. No, no, I
just
think finish. Yeah.
please go ahead.
So I just wanted to get a sense, like on the terms that you mentioned, which are under negotiation. Have you seen any recent ask that, let's say, a fund has a cap on its investment or exposure to any portfolio company to, let's say, 10% or 15%? Given the current liquidity scenario, have you seen GPs revisiting the fund documents to get an exception that can be invest a lot more capital in a portfolio company, especially because they are in need of a liquidity right now? So, have you seen those sort of conversations come through that despite the documents limiting exposure to any single at 10 or 15, however, given the unprecedented situation we are in, can you allow us a higher bandwidth on every participation that we make?
So, I think a lot of those situations, we will see a lot of those conversations popping up more and more towards the end of this month, or later on, in the next month. Because considering the situation, even in India right now, we are just kind of managing to brush under the radar. And I mean, considering the population and population density here, the pandemic hasn't really blown up that much. So, but people are still on a high alert. So I think most of the people out there, even placement agents to a large extent are just currently are just in a wait and watch kind of phase. And after that, yes, definitely we may see such situations arising uh, where to secure the portfolio or to make sure that the fund doesn't lose out on the in the longer term.
Sure.
More capital may need to be infused, and yes.
Okay. Thank you. Nandini, to you now, like from a GP perspective, are there any other negotiation terms that you have seen come up with LPs and any perspective, especially around management fee or carried interest calculations and so on and so forth? Have you seen any issues come up?
Sure. So I think both management fee and carried interest negotiations take an interesting turn when we talk about removal of the manager. If life is going on as is, then I think the 220 model is still working out. But when we talk about exceptional circumstances, that's when the dialogue becomes a little uncomfortable. Obviously, it is difficult to demarcate situations where you would want to penalize the GP and situations where it's a gray. For example, this situation that we are currently dealing with right now, we often see a right with investors to be able to terminate the commitment period. This is a discretionary right just with them, maybe a 75% or some similar threshold majority can come together and terminate the commitment period. If there is a GP who is not dealing with only a sophisticated set of LPs, by that I mean institutional LPs who are in the know-how of fund operations, then LPs may come together and decide that no more investments for this fund, let's just terminate the commitment period. So now I think going forward, there will be a fresh perspective on fund documentation where we may have to carve out situations like these, macro events which should not impact functioning of a fund because the LPs have discretionary powers. I think so far LPs were able to couch these rights and privileges as LP protection items, but going forward, they can't be unfettered. And second, on even removal provisions. So this was on commitment period termination, but even on removal provisions for the manager, I think we will need to be more careful about the consequences that we plan out depending on the cause. And the carried interest haircut will need to also be renegotiated depending on the kind of removal that is taking place. So yeah, these are just a few variants.
Absolutely. I think especially the part around the haircut on a no fault removal. I think that has been a very contentious point, and there has not been a common landing point evolved so far as the go-to option on this. Should it be on a straight line basis that depending on how many years have sort of gone by and the no default removal has triggered, then should that amount of pro rata be paid out, or should it be a function of taking an NAV on the current date, and all the different variations that can sort of kick in? I think with that, we also wanted to touch on the different structures which are now being explored by GPs um, uh, to attract the kind of LP audience they're looking for. So I think here there are three different approaches that are being taken recently. The structure has to accommodate LPs of all hues and shades. It could also mean, if required, setting up feeder vehicles. Uh, so insofar as offshore LPs are concerned, we still see Indian GPs looking at Mauritius and Singapore uh, more seriously than, let's say, the other European jurisdictions like Luxembourg and so on and so forth. The reason still is that if there are GPs who can demonstrate substance and decision-making CVs who are present in Singapore, it has now become the go-to option for those sort of GPs. Whereas in case of others who are not having a setup in Singapore already, we continue to see the use of Mauritius. But there, the caveat now is that Mauritius has recently been shifted by Financial Action Task Force (FATF) into a grey list where FATF would monitor the KYC and the beneficial ownership disclosures that are coming out of the LPs coming to Mauritius. So in those cases, we have seen some more discussion from the GP side that should they continue to look at Mauritius, but the answer to that continues to be yes. Barring informing the investors on the recent development, nothing much has happened there. Uh, in addition to the offshore options, now Indian GPs are also looking at GIFT City, uh, which is India's IFSC, International Financial Services Center model that we have adopted, where we would like to promote it at par with DIFC or Cayman, so to speak, as comparisons. And we are definitely looking at gift-based structures also going forward and see if LPs are comfortable with that. There are significant tax efficiencies in respect of management fee, GST leakages, which is why there is a lot more capital available to deploy if there is some saving on those components. Uh, so accordingly, a mid-shore type solution from Gift is also being explored. Besides that, we always have onshore AIFs. And over the last 5 years, we have seen a significant raise on the category 1 and 2 AIF platforms. And most importantly, we have seen global LPs, whether it is sovereigns, whether it is institutional investors, who have been comfortable coming directly into Indian AIFs because the regime allows the fund manager to write the absolute governance code that an international LP would expect. And all the rights and terms can be translated very articulately in these India-based documents, which otherwise were a lot more a domain of Cayman, Delaware, or Singapore type situations. Uh, and of a more recent origin is the fact that India now has got significant pockets of fund of funds. It is no longer the earlier institutions of LIC, SIDBI, and public-owned or public sector banks that are the LPs only, but there are meaningful fund of funds which have been evolved. Chief of them is NIIF's fund of fund, NIIF's master fund, and so on and so forth, who have been deploying significant capital to Indian GPs and in certain cases, in fact, even anchoring those funds. That gives a lot of confidence to global LPs because they now see an India quasi-sovereign fund also sort of coming in. And this structure, of course, is very unique because the GP also is owned by the LPs who have come in at the fund level. Besides that, there are other fund of funds also out there in India, which a fund manager can sort of look at accessing. And accordingly, setting up an AF in India becomes a meaningful sort of a situation. With that, I thought, Nandini, I'll just ask you a question. If you can tell me, like, from a structure perspective, how do you see this fund of funds scenario sort of building up? What should a GP should take into mind or take into account when they're looking to tap these allocations?
Sure. Thanks, Richie. So I think before I get specifically to fund of funds, I just wanted to put one thought out there, and to which I personally have been advocating for in the past couple of years at least. Just on the 1st of April, Hong Kong came out with its own limited partnership structure for funds. I think late in 2018 or early 2019, we saw Singapore coming out with its SVAC structures. I think it's high time that we in India take an initiative to that extent. And standardizing the PPM is one thing, but I think we need a more drastic step to reform the investment funds industry and how it operates from a corporate structure perspective in the country. There are issues, for example, when you talk about arbitration, it's the most commonly understood method of dispute resolution among all commercial transactions today. But when it comes to an AIF in India, it becomes a question mark because trust disputes are inarbitrable in India currently. Right. And at the same time, the AIF regulations permit you to, permit you to allow for any type of dispute resolution mechanism. Then there are other issues. The investment manager to an AIF is, after all, a service provider to the fund entity. And when we are filing overseas for marketing exemptions or otherwise, and we are asked for who is the legal owner of the fund, we have to make a case to those authorities as to why the manager should hold control. These are some basic issues which I think introducing a corporate structure which is specific for investment funds could really be a great achievement for us at this stage in India. Having said that, specifically for fund of funds, I think we discussed this even in our last webinar as to how it makes sense for certain kind of investors to come in to fund of funds as opposed to direct funds. And this, I think, makes most sense for sovereign LPs. And I think that is the trend that sovereigns follow worldwide, where they come into fund of funds so that there is an alignment between the manager who's managing their FOF and themselves as regards the direct funds in which their monies are ultimately being allocated. One interesting conversation that comes up for fund of funds, not in India anymore, but otherwise, is the tax efficiency. I think in India, we are quite clear on even in FOF structures, there is a complete tax pass through, so that should not be a concern.
Great. So I think just to add from that perspective, insofar as structures go, we have also seen the situations evolve in a very significant way in what is being addressed. And I think I'll just clarify there. There are a lot of fund managers who are looking at raising funds on a deal by deal basis. What I mean here is that LPs are looking at unbundling the entire portfolio and are looking at models which will allow them to cherry pick which investment their allocation is going towards. And accordingly, the structure that you spoke about, like a variable capital company in Singapore, does help that to a great extent. I think spending a little time more on that one, what happens there is that a variable capital company can have independent sub funds or sub classes, so to speak, and there can be different investors across the different sub funds. They in turn could be pooled together into an AIF, and the AIF would make investments. But in those cases, while the beneficiary to the AIF is the variable capital company, the VCC at the Singapore level could unbundle those investments and accordingly, on a ring-fenced risk or liabilities perspective, distribute the participation in the fund to the unique LPs who have come in the different sub-funds. So I think, again, that's a model that is definitely taking off, especially when we are talking about private equity VC strategies, which are 10-year, 12-year horizons. Instead of being tied together in the relationship as an LP for the entire path, the LPs are looking at a more investment by investment specific sort of relationships, which is where all these structural alternatives sort of definitely come into assistance. The second piece also was a secondaries fund, which are now suddenly picking up in India. You have a confluence of so many factors which assist this. To begin with, the dollar is already close to 76 record levels from a rupee perspective. You already have a lot of 2007-9 vintage funds which are still out there. They have already extended their terms by 1 year, 2 year, who are now slowly looking towards the zombie fund sort of a mode, that what to do. We are already 12th anniversary past our initial closing dates. Not to speak of the recent 2012-13 cycle funds, which are also now at the very fag end of their fund terms. So all of these are sitting on meaningful portfolios which have seen significant upturn or up value, but those are all paper profits. And accordingly, the fund managers are looking at getting some exit in those situations where a secondaries fund can literally pick up the LP stake. It could either be a LP to LP counterparty relationship, or it could be a GP which is assisting its existing LPs to sort of transfer the positions to an incoming LP, and accordingly, a secondaries fund of funds could be of a lot of help there. I think with that, I'll also request the participants on the call that if you have any questions, please do share that with us. This entire event is on listen only mode, but any questions that you may have, it does pop up on the box, and then we'll be more than happy to take up your questions. The next aspect that I wanted to touch was Ishan. I think a significant allocation, like I indicated earlier, comes from DFIs, and they have a lot of focus on ESG goals, or ESG at least thresholds being met by the fund manager. So, how do you see fund managers sort of taking those up, and what are the recent practitioners' perspective that you have on this?
Sure. So yes, like you said, an increasing number of DFIs and institutional investors otherwise have been looking at enforcing stricter ESG norms, basically trying to go beyond what are the requirements just under the local laws, and tying GPs to more robust standards and higher, which entails higher sensitivity towards social, labor, health and safety related concerns, environmental incidents, accidents, and so on and so forth. This is a big concern from both a legal and a reputational risk perspective for a lot of the LPs. And and as far as the domestic regime in India goes, over and above adherence to environmental and labor laws, we have seen the regulators and government bodies come up with um, uh, various developments, such as the CSR, the corporate social responsibility regime in the late 2000s. Then the Ministry of Corporate Affairs issuing voluntary guidelines for companies to follow. And from the securities regulator side, we've had SEBI publish requirements. SEBI come out with requirements for listed companies to touch upon some of these aspects in their annual business reports and so on. But what maybe the need of the hour is more sort of market-wide or industry-wide, a regime which even for private funds which fall within the AIF space, even the ones which are not taking capital from, say, such DFIs or such responsible investors, so to speak, should adhere to certain benchmarks, especially considering that publications by Morgan Stanley recently convincingly brought out an observation that the idea that sustainable investments are not are not favorable in terms of economic returns, or are falling short in terms of the returns that they offer to investors as opposed to the traditional investment routes. The fact that is a myth that is a myth that has been busted by them, and they have pointed out how sustainable investments are just as economically attractive or more in certain cases, although that analysis was not specifically in respect of India. But taking cue from that, I mean, we've seen ESG indices evolve on the Indian markets. We've seen managers like SBI come out with ESG dedicated ESG funds. But for say private funds and EIFs, more stricter in requirement which touches upon all participants in the market may still be required.
Sure. No, I think those are very helpful insights. I think what we have also seen is that a lot of DFIs have defined ESG norms, which are hardwired to the fund documents. This comes to them via the different LPs whom they're tapping. It could be DFIs. It could, in some instances, even be fund of funds, because those fund of funds in turn have DFI type participants. So ESGs are definitely here to stay. What is also coming through some of these asks from the LPs is also the focus on operational due diligence measures on the GP itself, we have seen some LPs insist as part of their side letters that they would carry out and conduct annual operational diligence on the GP. And this obviously is a very, very nuanced issue. uh, the GPs are sort of carrying out their exercises, and there are several reps that they've been giving in their documents on the way they run their operations. And accordingly, if an LP finds out an issue, is it an issue of a level which should be taken up with LPs? What could be the consequences of those diligence findings? Is the LP to begin with sophisticated to carry out a diligence, or do they use an external third party? What is their track record, and so on and so forth? So I think ESG plus operational due diligence and some of these other monitoring aspects on how GP is conducting its affairs is increasingly under an intense LP scrutiny, and this is just going to increase as we go along. I think while we have some other topics to cover, there are some questions also popping up. The first question was from Prachi. Her question is, how many offshore funds are set up in GIFT City till now? So I think I'll take that one. To respond, I think, Prachi, I think what has happened is that GIFT City has opened up for different market participants in different ways. The first was to encourage a lot of systems and uh, the platforms that you need to operate the market. So the custodians, the brokers, the banks, depositories, etc. They were the ones who first set up shop in GIFT. We then came out with a version of an FPI regulations that could operate out of GIFT, and they have access to GIFT-based liquidity. Eventually, we saw the rollout of AIFs out of GIFT, which is where a bulk of our interest lies. That how can GIFT-based AIFs be used for making investments, not just in India, but also in opportunities outside India, because GIFT-based AIFs are not bound by the restrictions and limits on their global investments. They are allowed to participate the full 100% of their investable funds and corpus to overseas opportunities also. The GPs, like I said, were finding this structure of the most interest and most keenness because this avoids GST as well as, in some senses, reduces the taxation on the management fee income that is being earned. It, however, does require that the GP, if they are an overseas GP, then, or if they're an Indian GP, even more so, that they have a demonstrable substance and a lot of CVs who are willing to spend some time in GIFT City and not just attend meetings through video conference calls and so on and so forth. Because unless you demonstrate commercial substance, it could be highly likely that the tax department could challenge some of the tax concessions, especially because what is the tangible connection, and is this all out there just to get a tax advantage out of all this? Hope that answers your question. The next question was from the mail from Pratham Jhunjhunwala. Uh, Pratham wanted us to discuss more on variable capital company structure and its basic features. So I think that, like Nandini indicated, we are yet to see a version of it roll out in India. But the way Singapore has rolled it out already is mostly in lines of how you would look at a protected cell company, a PCC type model in Mauritius or in Cayman, where what happens is that unlike a multi-class structure that you have in companies in India, where you can issue class A, class B shares, in a variable capital company structure, each class is behaving like a sub fund and they have their own unique legal personalities where they can enter into contracts, or they can frankly even ring fence the liabilities between one sub fund to other sub fund. The other advantage is that uh, the minimum cost requirements that has to be met from a Singapore perspective can be met collectively by all the sub funds on a combined basis. So this reduces the capital inefficiency of meeting the expense test criteria for each sub fund on a sub fund to sub fund basis. The other aspect is that it also relaxes the insolvency test criteria and the other rules. And it also allows redemption of shares or payout of dividends out of the capital received by the Singapore company, which again was challenging from the Local Companies Act perspective earlier. So I think a lot of keenness, lot of interest. We have already seen the first list of 20 VCCs which have already begun operations when the new regime sort of came about, and Singapore is definitely pushing these structures and marketing these structures very well. And in all cases where a VCC type structure works, we would definitely recommend that this should be looked at very seriously. I think the next question was from Harsh. His question was that given that public equities markets have corrected a lot, do you see PE funds investing in pipe opportunities given the advantage of liquidity in the portfolio? So Harsh, again, from a practitioner's perspective, the view would be that if there are private equity funds, they would have a problem in their own hands to deal with as well. It's not as if in March, if public markets sort of came down by 40% and what was worth $50 became 30, whereas the private equity remains at 50 still. That's not the case. A lot of conversation from the GP to the LP base has been that, look here, the portfolio that we are holding on is also, having a suboptimal business environment to deal with, and obviously the valuations and the multiples are definitely coming down. So if a fund manager were to approach an LP or to tell them that, look here, we want to do a style drift, and instead of looking at a illiquid situation, could we look at a liquidity situation? I don't think a tier one GP would be having many such conversations. But again, we from a legal advisory perspective may not have the full insight as to what conversation a GP is having with an LP. After that, we see another question from Ankit. Ankit, I think your question is that considering the market situation globally and in India as well, do you see any new compliance or risk-related challenges in near future? Government provided certain relaxation in reportings, but beside that, any other challenge? So Ankit, it's a good question. I think what has happened is a coming together of a lot of factors, which is where I'm very optimistic on. I don't think any new challenges will be thrown out in the path of investors. I think to begin with, we already started with an ambitious aim of being a $5 trillion economy. On top of that, we had our own cleaning up issues in the financial services. You have seen all the other controversies that have broken out. So accordingly, with COVID also coming in, I think we are definitely going to get in a situation where governments is going to be all arms open. Let's attract foreign capital as much as we can. And there is going to be a lot of pressure in case they come out with any law which creates any challenge or makes investment into India environment suboptimal from where it is right now. So personally, I would feel that don't see any new challenges coming together unless those are very momentary challenges where they have restricted physical movement or they have restricted certain short sale type opportunities in public equities. But barring these, don't see any new challenges coming, which are not driven only by COVID. I think with that, there are more questions popping up. We'll take them as quickly as we can. So Prachi's question was that, do you think the LPGP terms will, with respect to management fees and carried interest, will be affected? Or do you think it's a temporary phenomenon and should not impact the terms? So I think there was, like Nandini indicated, there was already some discussion on management fee and carried interest, which was already out there. Management fee continues to be at 2, but there could be variations to 1.5 or to larger anchor investors. You can always, the LP could negotiate a smaller number. It could be gross of GST, it could be net of GST. Those aspects are also there. But I think where we see some changes coming in is a blended management fee kicking in. It is not any more usual that the 2% will be on capital commitment to begin with, and the base will then change to cost of investments after the commitment period is over. It is more about blended fees that can we have 75 bips on commitment and 125 bips on cost of investments, or 1% on commitments and 1 on cost of investments, because that would sort of both encourage fees being paid on commitment, but at the same time it would put some premium on making sure that the GP is also making the investments. Again, the discussion also comes up that if the fund is in its exit mode and there is new fees coming from a successor fund, could that also have some impact on the management fee? Again, there the discussions is significantly progressing because more and more GPs are getting cycle tested, new series of funds getting launched. A Series 3 GP is very different from a Series 1 or a Series 2 GP. So a lot of these negotiations are maturing and taking into perspective all the aspects that I spoke about. The next question is from the line of Karthik Tyagi, and maybe Nandini, if you want to take it up. The question is that in addition to investments directed to a specific sector, is there also any limit on the minimum amount of investment by LPs? So I think this is an interesting question. The question is limit on the minimum amount of investment. I hope it's not a typo. Otherwise, a more routine question would have been any limit on the maximum amount of investment by LPs. But having said that, Nandini, do you want to take this up?
Sure. So I think in terms of AIFs, at least, Karthik, there is a minimum of 1 crore of investment, Indian rupees of 1 crore of investment required in AIFs by third-party investors. By that, I mean who are not manager or manager's employees for profit sharing participation in the fund. And other than that, there can be a contractual minimum also in the fund documents, which is entirely commercial. From a regulatory perspective, it's 1 crore rupees.
Right. But on your deal ticket size, I think maybe some of the GPs whom you have interacted with, I think one sense you were getting is that can they put more capital at play in the existing portfolio company? Can they look at debt type instruments to participate? Because they were equity oriented. So maybe some experiences you want to sort of share.
Sure. So yeah, we are short on time, but I'll try to quickly summarize. But I am having a few conversations with funds which are running and operational, where given the current situation, portfolio companies need some quick capital, some quick funding, and for that, GPs are having to discuss with their LPACs how they can maximize value for their portfolio companies at this stage, and in what form, including a shift of instruments, choice of instruments in those portfolio companies from, say, a regular equity or convertible equity to optionally or non-convertible debt.
Sure. Thank you. The next question was from the line of Harsh Hanuka. Your question is, do you see distress selling happening in PVC funds, given that LPs will not further extend the fund period, given the liquidity requirement at their end, and this impacting the valuations in the private market industry? So, see, I think what we specialize in is on what happens in on top of the fund, the LP type situations, and what are the issues which are coming up in this scenario. I think more than COVID, even before COVID had happened, there was definitely a lot of stress, and a lot of funds which were 2007-8 vintages, or those which are from 11-12-13 vintages, are under a lot of pressure to create liquidity for their LPs. Now, there are broadly 5 different channels of creating this liquidity. The first one is an LP to LP sale of LP position, which is an LP secondary. The second one is a GP sponsoring a bunch of LPs and selling their stake as a block to a new incoming LP, so that the new LP, instead of negotiating with individual LPs, gets one full larger bundle of LP positions and hopefully strike a newer conversation with the GP that what are the new terms that we're looking at, and should there be an increase in the term of the fund. The third aspect is that either you can do a single asset sale or you can do a complete asset swipe out, where the fund could say that, look here, I am sitting on 3-4 investments which have value but not able to find a meaningful exit. Then could they do a portfolio secondary with another fund? And that is something that we have very commonly seen over the last 2-3 years. The last option is, which we are testing out with one of the GPs currently, and definitely see this having a significant uptick over the next 2-3 years, is a GP-led restructuring, where what happens is that the GP, which is acting as a manager as to the current fund, sets up a new continuation vehicle where a new LP comes in and buys out the portfolio of the current fund. Now, to manage the process, the fund manager also offers to its existing LPs that look here, there is still some more runway left, some more path for a meaningful exit on the portfolio. Accordingly, happy to have you guys also on board the successor vehicle or the continuation vehicle that is being set up. And accordingly, option could be given to the LPs that, okay, either you get liquidity because the new successor vehicle is going to acquire the portfolio and that cash can be upstream to you, or you could sort of roll over to the new successor vehicle because there is a lot more value still left in the portfolio. In those cases, there are quite a few conflict of interest type situations that can come in because the GP is acting as a manager to the current fund, and obviously getting the highest possible value is part of the fiduciary of that role. Whereas the fund manager is also acting as a GP to the new fund, the continuation vehicle, where obviously the clock is going to reset on the IRR and the calculations. And accordingly, the fund manager is motivated to keep the acquisition cost as low as possible. Now, in some cases, LPs have taken a view that because it's a common GP, one fiduciary obligation cancels the other fiduciary obligation. Answer to that is squarely no. You have to look at each of them very, very granularly and make sure that all the conflict related aspects are taken care of. But this is somewhat complicated because it's combination of a new fund being raised, M&A of the complete portfolio of the existing fund, and so on and so forth. So it's a combination of a larger transaction plus a fundraise all coming together in one bag. And accordingly, there is some sophistication to achieve these structures and these results. Again, something that we feel should come up over the next year or two. I think with that, we will wind up the session. And before I end, obviously would like to thank my co-panelists, Nandini, Pathak, and Ishan Vyas for joining in. And I would also like to thank all the participants on the call who have joined us for the session. Hope you saw value in this and hope you leave this session with more knowledge on some of the issues that we are grappling with or the industry is grappling with. Or if you were not aware, then hopefully you are now aware of what issues you were not previously aware of. So with that, I'll again hand over the control to Vanessa, who is the host for the session, and we look forward to having you for many such sessions in future as well. Over to you, Vanessa.
Thank you to all our speakers for a very insightful and educative discussion this evening. Yeah.
Vanessa, I think the audio at your end is not clear. So I think
You can repeat.
if you could repeat. Okay. I think in the interest of time, then let me do the honors there. So, A, we have thanked you for joining our session. B, you can reach me or Nandini or Ishan over email, and you would have our coordinates separately sent to you. We now also request you to join our next WebEx session, which is going to be at 9 p.m. This is going to focus largely around impact investments and some of the recent issues that our team continues to look at. Our firm has a deep history and deep engagement in the entire space, and we have been pioneers in designing some of the structures that allow for impact investors to sort of participate. We look forward to having you all for that session. Thank you, everyone. Cheers.